All right, before we draw anything on this chart, I want you to just look at price for a moment. Most traders jump straight into indicators, entries, or predictions, but smart money trading starts with one simple question. What is price trying to do right now? Not what we hope it will do, not what we want it to do, but what it's clearly showing us. And if you miss this first step, everything else becomes random. Now let's start from the left side of the chart. The first thing I'm doing is identifying market structure. I'm not forcing anything. I'm not trying to be clever. I'm simply marking what is obvious to everyone. You can clearly see price making lower highs and lower lows. At this point, sellers are in control of the market. There is no reason to look for buys here. There is no reason to predict reversals. We trade what we see, not what we want. Pay attention to what happens next. Right here, price breaks above the previous lower high. This is a break of structure, also known as BOS. This is important, but it's often misunderstood. A BOS is not a signal to enter a trade. It's not a buy signal. A BOS is information. It tells us that something has changed in the market. It tells us sellers are losing control and buyers are starting to step in. So after a BOS, we don't chase price. We don't buy out of excitement. We simply update our bias. After a valid break of structure, smart money expects one of two things. Either price continues higher with strong momentum, or price pulls back to rebalance orders. And this pullback is where opportunity is created. This is why buying breakouts usually fails. Smart money doesn't buy highs. Smart money buys discounts. Now let's shift our focus to the upper part of the chart. Look at this high right here. This level is very important. Why? Because above this high, buy-side liquidity is resting. This includes stop losses from short sellers and buy stop orders from breakout traders. Liquidity attracts price. Price doesn't move randomly. It moves with purpose. Smart money understands this. If they want to move price lower later, they first need to collect liquidity from above. That's why this high becomes a future target, not a resistance level. Now let's come back down to the lower time frame. After price reacts from the high, we start seeing a change in behavior. Right here, we get a lower time frame change of character. This tells us that momentum is shifting on a smaller scale. Buyers are no longer pushing price aggressively higher. Sellers are beginning to show strength. This does not mean we sell immediately. This is a warning, not an entry. It tells us to slow down and pay closer attention. Now look at this next move carefully. Price pushes slightly lower, then pulls back up. This is inducement. Inducement is designed to trap traders. It encourages early entries. It encourages traders to sell too soon. It encourages tight stop losses. Smart money uses inducement to create liquidity. They want traders positioned incorrectly before the real move happens. If you enter here, you are not trading smart money, you are providing liquidity. Now price moves deeper into this zone. This area right here is our point of interest. This is also known as an order block. This zone represents the last strong bullish move before price expanded higher. This is where institutions are likely positioned, but this is very important. This zone is not an automatic buy. It is an area where we expect a reaction, not an entry by itself. Smart money traders wait for confirmation. As price enters the point of interest, we slow everything down. We stop thinking about entries. We start observing. We look at candle behavior. We look at momentum. We look for signs of exhaustion. Bearish candles start getting smaller. Momentum begins to fade. This tells us selling pressure is weakening. Then on the lower time frame, we see an internal structure shift. This is our confirmation. This is where we enter the trade. The entry is taken only after confirmation closes, never during the move, never out of hope. Confirmation comes first. Now let's slow down here because this part is where most traders lose money without even realizing it. This move right here is what we call inducement. And inducement is not random. Inducement is designed behavior. Price moves in a way that makes traders feel comfortable entering too early. It creates the illusion that the move has already started. Small pullbacks, weak pushes, shallow retracements. All of this is meant to do one thing: convince traders that they're early, smart, and right. But that confidence is exactly what smart money needs. Inducement exists to build liquidity. It encourages traders to enter in the wrong location. It encourages sellers to sell too early. It encourages buyers to chase too soon. And most importantly, it encourages tight stop losses because when traders feel confident, they reduce their margin for error. That's why inducement almost always happens before the real move. Smart money doesn't move price aggressively until enough traders are trapped. If price moved straight into the order block without inducement, there wouldn't be enough liquidity. So this pause, this hesitation, this small reaction is intentional. It's a trap. And if you don't understand inducement, you'll always feel like price is hunting your stop. But price isn't hunting you, it's reacting to where liquidity is placed. Now, here's the key difference between amateur traders and consistent traders. Amateur traders try to avoid inducement. Smart traders expect it. They wait for it. They need it. Because inducement confirms that smart money is preparing for execution. If price goes directly into a zone without inducement, that setup is weaker. Inducement is proof of manipulation, and manipulation is necessary for distribution. Now let's talk about why most traders are not profitable long term. And this has nothing to do with entries. One of the biggest reasons traders fail over time is inconsistent risk management. Most traders focus too much on being right. Professional traders focus on surviving wrong trades. You can have the best strategy in the world, but if your risk is not controlled, it will destroy your account slowly, or sometimes very quickly. Here's a hard truth. You don't blow accounts because of one bad trade. You blow accounts because of poor risk habits repeated over time. Risking too much when confident, risking too little when afraid. Changing position size based on emotions, moving stop losses, revenge trading after losses. This is not trading. This is gambling with technical analysis. Smart money traders think differently. They risk the same percentage every single trade, whether they feel confident or not, whether the setup looks perfect or average. Consistency is more important than conviction. A good rule for most traders is risking between 0.5% to 1% per trade. Not more, because your edge plays out over a series of trades, not one. If you risk 5% on one trade, you're not trading probabilities anymore. You're betting, and betting always ends emotionally. Risk management is what keeps you calm. It allows you to wait. It allows you to accept losses. It allows you to execute without fear. When risk is defined, emotions disappear. When risk is undefined, every candle feels personal. That's why smart money traders define risk before they enter, not after. They know exactly where they're wrong. And they're okay with being wrong because one loss doesn't matter. But breaking risk rules does. So when you combine inducement with proper risk management, everything changes. You stop chasing, you stop forcing trades, you stop blaming the market. Instead, you wait for price to show its hand. You enter only when conditions are met. You risk a fixed percentage and you let probabilities work. This is how trading becomes boring, and boring is good because boring is consistent, and consistency is where real profitability lives. Now that inducement has played out, this is where we focus on execution. Liquidity has been taken, traders are trapped, and price is reacting inside our area. This is exactly what we were waiting for. From this point, I'm entering the trade right here at the reaction inside the order block. This is not anticipation, this is execution. The entry is taken from this level after inducement has done its job. Now let's define risk. Our stop loss goes below the lowest point inside the point of interest. If price breaks that level, our idea is invalid. No emotions, no hesitation. Losses are part of the process. Undefined losses are not. Now let's talk about targets. Remember the high we marked earlier? That is buy-side liquidity. Markets move from liquidity to liquidity, so our target is clear. The take profit is set at the buy-side liquidity above the highs. This gives us a logical target and a clean risk-to-reward ratio. Once price starts moving in our direction, we don't interfere. We don't close early out of fear. We don't move stops randomly. We let the plan play out. One trade doesn't matter. Consistency over time does. Let's recap the entire move from left to right. First, we identified market structure. Then we waited for a break of structure. We marked buy-side liquidity. We waited for a lower time frame change of character. We allowed inducement to form. We identified the order block. We waited for confirmation. We entered with defined risk and we targeted logical liquidity. No guessing, no chasing, no emotions. This is smart money trading, calm, structured, repeatable.